Want higher ETF income without trading options? Covered Call ETFs can pay you extra, but they're also going to cap your upside. And here's exactly how they work and when to use them. If you're new here, welcome. I'm Stefanie, an ex-tech professional, a data enthusiast, and a long-term index investor. My husband Joseph and I are a debt-free family of 4 living here in beautiful Portugal, and we focus on building wealth through simple, accessible strategies like our multi-six-figure Covered Call ETF portfolio that can help us fund our lifestyle with balance and purpose. This isn't just about the money. It's about creating freedom, designing a life that I love, and sharing honest conversations with you about our journey to financial independence. And if you're ready to take control of your financial future, hit subscribe and join us as we talk investing, wealth building, and living intentionally. Today, I'm going to explain the mechanics of Covered Call ETFs. I'm going to show you simple math, reveal exactly which Covered Call ETFs we have in our portfolio today that are generating us $4,700 a month, and tell you the exact market setups where these ETFs win and where they lose so that you can make the most informed decision for yourself when deciding whether to include them or not include them in your strategy. Now, not long ago, if you wanted the income benefits of covered calls, you faced a steep learning curve. Complex options trading was the only path, but now those barriers have fallen. Now, income generating strategies are far simpler to access, and the market's progress has been clear. Greater diversification, lower costs, and more ways to generate dependable income. And that all began with individual stocks and then broadened its access through mutual funds and ETFs. And now Covered Call ETFs bring sophisticated income strategies to everyday investors. And the benefits can be substantial. So consider these choices. For growth, you could own NVIDIA and try your hand at actually writing covered calls. And then you have stable dividend aristocrats like Johnson & Johnson that give you something like 2.78% dividend yield,
BTI
1.13%, Vanguard's VYM with its reliable 2.53%. But for investors that are prioritizing income without the hassle of active option management, the NOES S&P 500 Income ETF SPYI is at 11.69%. That's compelling for many portfolios and for those who might need to catch up later in life when it comes to retirement. Funds like VTI and QQQ let you instantly access diversified portfolios and growth. Dividend and covered call ETFs allow you to outsource some of the sophisticated income generation options that are available out in the market. And the bottom line is the tools for generating steady income are now within everyone's reach. Whether you prefer growth, stability, or high current income, this evolution means that you have more control and you have a lot more choices for yourself. So to really grasp covered calls, it's helpful to see the alternative. So let's compare selling a call option without owning a stock. We're gonna stick with our example of NVIDIA. And in a covered call, you already own NVIDIA shares. You're simply selling someone the option to buy something that you already have. But if you don't own the shares and you sell a call option anyway, that's a different story. So let's say that you sell a call option on NVIDIA with a $1,010 strike price, but you don't actually own NVIDIA shares yet. Now imagine that NVIDIA's price skyrockets to $1,050. The buyer of your call option will definitely exercise it, and that means you're now obligated to provide them with 100 shares of NVIDIA at $1,010. But since you don't own those shares, you now have to rush out into the market and you have to buy them at the current price of $1,050. So you're gonna lose after subtracting the $2,000 premium you initially received. And that's the danger of naked calls. Your profit is capped at the premium, but your losses are literally unlimited. So now let's look at covered calls. With a covered call, you already own at least 100 shares of NVIDIA. You sell the call option against the shares that you already possess, and if NVIDIA stays below the $1,010 strike price, then you get to keep that $2,000 premium. Same as the naked call, but if NVIDIA rises above the $1,010 price, then the buyer's gonna exercise their option. You sell your shares at the strike price. Yes, you miss out on the further gains, but still you're gonna pocket that $2,000 premium. And here's the key difference. The covered call is going to cap your upside. You're not going to participate in those additional gains above the strike price, but it also provides a buffer against the losses. The naked call offers the same limited profit, but it's going to expose you to unlimited downside risk. And covered calls aren't just about getting rich quick. They're a strategic way to generate income from stocks that you already plan to hold. And selling naked calls is just that, speculation, plain and simple, and should only be attempted by a sophisticated trader who is really going to understand the risks. So now that we talked about the evolution of access to covered calls, now let's deep dive into how a covered call ETF, like the NEOS S&P 500 Income ETF SPYI, actually works. The buy right strategy has 4 core steps. SPYI buys a basket of stocks that make up the S&P 500 index, and this is the list of the 500 largest publicly traded companies in the United States. Then SPYI sells the call options on a portion or all of the portfolio. And when I say a portion, that means that some funds will choose to expose the fund to capped upside. That's inherent in the covered call strategy on a portion of the fund versus the entire fund, like some of the old covered call ETFs used to do. SPYI then collects premiums from those sales, and that's cash directly into the fund. And finally, as options expire, SPYI either closes the expiring options and opens new ones, or they roll them. And remember, these premiums are cash now. They provide a buffer against the losses in down markets, but they also reduce how much gain that you're going to make if the markets explode higher, that capped upside. So now that we know what the buy right strategy is, let's define a few essential terms that you're going to encounter whenever you decide to research covered call ETFs. And don't worry, it's a lot simpler than it sounds. So first we have the premium. That's the price that the option buyer is going to pay to the option seller. And in this case, an ETF like SPYI for the right to buy shares at the strike price. Speaking of the strike price, this is the price at which the option can be exercised. So if the stock price is above the strike price, then the option is said to be in the money, or ITM. Now, time to expiry is simply the length of the option contract. It's when it's written and to when it expires. So SPYI typically uses monthly options. And finally, moneyness. It's going to describe the option's relationship to the stock price. So in the money means that the strike price is favorable to the option holder, lower for the call, higher for the put. At the money means that the strike price is near the current stock price. And out of the money means that the strike price is not favorable to the option holder, higher for the call, lower for the put. Okay, so let's walk through an example with easy numbers. Imagine SPYI owns a stock that is trading at $100. They sell a call option with the strike price of $105, expiring in 1 month and receiving a $2 premium. So now let's look at 2 possibilities. First, the stock could finish at $104 at the end of the month, and that option is going to expire worthless. And SPYI is simply going to keep that $2 premium. Second, what if the stock price rises to $110? The option is then exercised. And SPYI is going to sell the stock for $105, but it's also going to keep the $2 premium. So SPYI's total income is going to be $7. The $2 premium plus the $5 difference between the purchase price of $100 and the strike price of $105. So in this case, SPYI made the $7 versus the $10 if they had simply held the stock outright. And this is what's illustrating the capped upside of covered calls. So when do covered call ETFs really shine? It depends on the market environment. So we're going to look at 2 scenarios, a sideways market and a bull market using historical data. So first we have the sideways market. We're going to think about 2011, where we had minimal growth, ups and downs, but ultimately flat. In 2011, if you invested $100,000 in PowerShares Buy Right ETF, this is ticker PBP, you would have received a dividend yield of 10.8%, generating $10,850 in income. Due to the sideways market, the value of the underlying shares would have decreased by about $3,210, but even after that loss, your total return would have been $7,640. By comparison, if you had invested $100,000 in Vanguard's high dividend ETF ticker VYM, you would have received a dividend yield of 3.25%, generating $3,250 in income. Your shares would have lost about $920 in value, leaving you with an overall total return of $2,330. In a sideways market, PBP's covered call strategy significantly outperformed the traditional dividend ETF. And now let's shift gears and look at the moderately bullish time frame. We're going to use October 2024 to now November 2025. And during this period, PBP's dividend yield was 11.16%, generating $11,160 in income. The ETF also experienced $1,350 in share appreciation, leading to a total $12,510. However, VYM generated $3,270 in dividend income, plus an additional $9,840 in share appreciation, delivering a total return of $13,110. The lesson here is really clear. If you expect low returns but want steady checks, covered call ETFs like PBP shine. But if you're expecting a strong market rally, you're likely leaving money on the table. And choosing between covered call ETFs and a dividend ETF is about aligning your strategy with your market outlook and your income goals. Understand the trade-offs, and you'll be well positioned to make informed investment decisions. If you're finding this breakdown helpful and you're learning something new about covered call ETFs, give this video a quick thumbs up. It's going to help people discover more videos like this and our content. And of course, subscribe if you're not already part of our community. When you do, you're going to see my covered call ETF playlist that covers all things covered call ETFs, like are these good for retirement planning, taxes, dividend traps, and so much more. And before we dive into covered call risks and practical steps, you've been asking for this view for a while, a view of our portfolio. So let's do a quick portfolio update. Our goal here is simple. Generate about $3,500 a month to cover our rent and our utilities while keeping the account relatively stable. So currently we are invested in 4 specific funds: SPYI's NOES S&P 500 High Income ETF, JEPQ, JP Morgan's NASDAQ Equity Premium Income ETF, QQQI, NEOS's NASDAQ 100 High Income ETF, and BTCI, BTC's Covered Call ETF option. Last month, these funds paid us a total of $4,714, exceeding our original target. And given our success over the last 3 years, we are really considering allocating another $100,000 to covered call ETFs that match a more aggressive income strategy. So let me know in the comments below if that's something that you want to see unfold in real time and what covered call ETFs that you're investing in these days. So if you're considering adding covered call ETFs to your portfolio, here are a few practical steps that I think you need to consider and key risks to keep in mind before you invest. Remember, there is no free lunch when it comes to investing. There's always going to be a trade-off that you need to be aware of. So first, how do you pick the right one? We're going to start by examining the fund's fact sheet. We're going to look for these key details. What percentage of investment goes towards fund management fees? Does the fund use monthly or quarterly options? What percentage of the portfolio is covered by options overall? What index that the fund tracks? Is it the S&P 500, the NASDAQ 100, any specific sector? Does the fund hold stocks that are already paying high dividends? This could impact the tax situation underlying the fund. Covered call ETFs can also have complex tax implications, so you want to consult with a tax professional. And I do have a video that covers covered call ETFs, dividends, and taxes. That's here and in the description somewhere below. So now for the risk checklist, and I want you to keep these potential downsides in mind so that you're making the most informed decision for yourself. Your potential gains are limited when the market rises sharply. The premiums generated by covered calls can also decrease during periods of low volatility. Your income stream is reliant on the fund's ability to consistently generate premiums, and the fund's performance may deviate from the underlying index due to the option strategy. And as mentioned, covered calls can have some complex tax implications, so understand the rules of the taxes before you decide to invest. All right, so let's wrap things up with 3 key takeaways. Covered call ETFs are ETFs that generate income by selling call options on existing stock holdings. They work best in sideways markets and moderately bullish markets, but remember, you need to watch out for capped upside and potential tax complexities. Remember, covered call ETFs are a tool They are not a cure. Use them when you want income, and that you're also going to accept the limited upside. And now I have a question for you. Are you already using Covered Call ETFs, or are you considering them? Tell me why in the comments below. Is it primarily for income, for risk control? Why does it fit your specific situation? And remember the playlist for the Covered Call relevant videos that I've created in the past, covering taxes, are they good for retirement, some fun deep dives, and more. You can check that playlist out here on the screen. And lastly, but not least, if this video helped you get a better understanding of Covered Call ETFs and how to start creating a life of financial freedom on your terms, please be sure to like the video and subscribe to our channel. We are always excited to share a more open and honest experience of how to give yourself permission to be wealthy.